Whaley, you have a fascinating view, and it's so much avoid the U.S., lighten up on the U.S., and look in other places. Let's start with your caution on the United States. Why?
I would caveat it by saying that it's not so much as a caution on the US as much as it is a view that the next leg of this cyclical restart trade can be better played in other regions, the likes of Europe, the likes of Japan, where restart is broadening out. So you talked about peak growth. Yes, we have seen peak growth acceleration in the US, but that baton of growth acceleration is getting shifted from the US to Europe, to Japan, which are the areas that we're becoming more favorable of in this environment. But now you say that we have lowered our conviction on US equities. Yes, we have. But at neutral, it is still 60% of global equity benchmark. It's still the largest part of our investors and our clients' equity portfolio allocation. And we continue to think that the broader backdrop of above trend growth and very negative real rate should still support a broadly pro-risk environment. So yes, we're upgrading Europe, we're upgrading Japan at the expense of lowering our overweight in US equities down to neutral. But more broadly, it's really a reaffirming of our view, stay invested, and we still want to be pro-risk.
Well, I hear the call on the European economy. The United States opened before Europe, it recovered before Europe. It makes sense that Europe would lag and they'll take the baton and do everything you've just described. The equity market didn't. The Euro Stoxx 50 outperformed the S&P 500 in the first half, and that's where people are a little bit unconvinced of the trade right now. They understand the economic framework. They're struggling with the market call. Can you convince them?
Absolutely. Well, I hope. If you think about kind of on a year-to-date basis, yes, European equities have done very well. But if you compare the performance since pandemic low, so talking about back to last March, European cyclicals are still lagging US cyclicals quite a bit. So we're talking about still quite some room for European cyclicals to catch up with their US counterpart coming out of the pandemic. So it's not time horizon matters. It's not just this year. And I would also say that in terms of European equity views, we do think that the growth restart absolutely is an underpinning factor. At the same time, our working assumption that has not been challenged so far, that the vaccination progress represents a delay, not a derailment of the restart story, that very much underpins our conviction in European equities as well. So earlier this year, we upgraded it from underweight to neutral when sentiment was very, very negative. So that was a relative, more constructive view than the street. And that is why at this juncture, we're further upgrading European equities into overweight.